Bismillahirrahmanirrahim. Good morning, and thank you for joining us for the release of our flagship publications, namely the Annual Report, the Economic and Monetary Review, and the Financial Stability Review. The fact that this is a virtual press conference shows that this is indeed an extraordinary time. The world is going through a testing moment, and as a nation, Malaysia has already had to face a number of surprises this year. This morning, I will speak about our assessment of the economic outlook in 2020, particularly in light of COVID-19. I will also elaborate on the measures we are taking to weather this storm and the recovery we can expect. Governments around the world are taking unprecedented steps to combat the pandemic. This range from travel restrictions, bans on large gatherings, and forced business closures to blanket quarantines. While these measures are crucial to effectively slow the spread of the virus, they are also triggering supply and demand shocks. As a result, economic activity in most countries have decelerated sharply. Growth prospects for both advanced and emerging economies are deteriorating. The IMF and many forecasters are expecting a global recession. Malaysia is one of the more open economies in the world, with trade of around 120% of GDP. As such, we will certainly feel the effects of the collapse in global demand. Already, weaker growth in our major trading partners has affected the demand for our goods and services. Disruptions in global supply chains have slowed down our manufacturing industry. Services have also been adversely affected. The movement control order and efforts to promote social distancing are crucial for public health. However, these measures have also implications on economic activity. Thus, it is certain that consumption, investment, and trade activity will be significantly affected. While COVID-19 will cause significant disruptions to the economy, the government is determined to limit its effects. The economic stimulus package introduced aims to prevent the health crisis from permanently affecting our economic potential. It does so in four ways. First, it ensures that our healthcare system and personnel are adequately resourced to combat the health crisis. Second, it gives households a financial safety net. Third, it provides some assistance to SMEs and corporates to ride out the temporary impact of COVID-19 on their businesses. And fourth, it enables viable businesses to seize growth opportunities when they arise. The immediate focus is to manage this transitory shock by minimizing permanent dislocations and long-lasting harm to individuals and businesses. In total, the 250 billion worth of stimulus measures are estimated to add 2.8 percentage points to the 2020 GDP growth. On our part, Bank Negara will ensure that the financial system continues to meet the needs of the economy. At the most basic level, this means making sure customers continue to experience uninterrupted access to basic financial services even during this MCO period. On top of that, the financial sector has stepped up to offer breathing space to their customers, especially households and businesses badly hit by COVID-19. As announced last week, financial institutions are offering loan deferments and other flexibilities for customers to preserve their insurance and takaful policies. In addition, SMEs can obtain financing when needed to sustain business operations and preserve jobs. The bank has encouraged these measures by freeing up regulatory buffers built during good times. We have lowered the SRR and given financial institutions flexibility to draw on capital and liquidity buffers. We are allowing this flexibility only because we know that the financial system has the capacity and ability to do so. Our efforts to instill discipline and prudence among financial institutions over the years is paying off. These buffers have enabled the financial sector to be prepared to mitigate the present shocks and help the economy stabilize. More specifically, banks have strong capital positions with a total capital ratio of 18.4% compared to 12.6% during 2008. The bank's liquidity coverage ratio have also increased to 148% compared to the 2015 to 2019 average of 137%. Following prudent risk management practices, impairments have remained low at 1% in February 2020 compared to 2.9% in 2008. Banks also hold provisions that can cover 125% of their impaired loans. In recent stress tests, we found that financial institutions can withstand extreme shocks beyond those experienced in the past. Results affirm that both the banking and insurance and takaful sectors have excess capital that will be enough to absorb significant losses while continuing to support the economy. The developments surrounding this pandemic is continually evolving, making it difficult to predict with precision. Our current assessment is that the economic impact is within the range of shocks simulated in our stress test scenarios. We continue to closely monitor the impact of current developments on individual financial institutions. Naturally, the uncertainties surrounding COVID-19 has led to greater risk aversion in global markets. As a result, volatility in domestic markets has increased and valuations have fallen. Nonetheless, I want to highlight that intermediation in domestic financial market continues to be supported. The bank will ensure through our open market operations, which include reverse repos and purchase of government bonds, that there is enough liquidity in the system. Already, the recent adjustments in SRR and flexibility granted to principal dealers have released approximately 30 billion ringgit into the banking system. Banking system liquidity remains ample with 159 billion ringgit of surplus. This is despite approximately 25 billion of to-date portfolio outflows. I also wish to point out that the adjustments in asset prices in the domestic financial market has been in line with the experience of regional peers. Malaysia's flexible exchange rate policy also provides a buffer against external shocks. The bank will continue to monitor the market and take measures to avoid excessive volatility that would disrupt trade and investments. In light of all these considerations, we project Malaysia's GDP growth for 2020 to be between -2% to positive 0.5%. In the first half of this year, spillovers from the global slowdown and our own pandemic containment measures will result in large output losses. This will take a toll on the economy, but it is necessary to keep the pandemic at bay. And at the end of the day, the preservation of life is paramount. Aside from COVID-19 related concerns, we can also expect to see continued commodity supply disruptions. The drought last year will affect oil palm yields, and maintenance works will hamper production in a number of oil and gas facilities. We are mindful that the situation surrounding COVID-19 is highly fluid and the situation is constantly shifting. The GDP forecast of -2 to positive 0.5% is our best estimate based on what we know today. Great uncertainty remains. Beyond the measures I already mentioned, there are other factors that will help towards recovery. First, there are strengths in our economy, and the COVID-19 has not altered this fact. We do not see price pressures, rather, inflationary pressures are subdued. Our current account position of the balance of payments remain positive of around 1 to 2% of GDP, and Malaysia is still a highly diversified economy. These conditions will allow us to better face the current challenges. Second, the government is expected to continue large-scale infrastructure projects, which will provide an additional lift to growth. For 2020, we estimate that the 15 billion in capital expenditure to build major transport infrastructure will help lift the 2020 GDP growth by 1 percentage point. Third, national authorities across the world are also introducing significant fiscal and monetary interventions. This will provide some lift to global demand. Recognizing that these are exceptional times, a number of governments and central banks have already committed unprecedented amounts to help the global economy ride out the present shocks and begin the journey towards recovery once the health crisis is contained. These are trying times. I believe we have got what it takes to endure and emerge stronger. Malaysia has done this before, and we can do it again. On our part, the bank has a broad range of policy instruments at our disposal. These include monetary policy, macroprudential and microprudential policy, as well as our supervisory oversight over financial institutions. These policy tools have served us well in the past. We will continue to assess the situation as it unfolds. The bank has the flexibility and space to deploy these levers to promote monetary stability and financial stability and ultimately support sustainable economic growth. As a nation, it matters that we make the right choices now. Malaysia will need to undertake the necessary reforms so that we are well positioned to face new economic realities, especially once the global economy and investor sentiment begins to recover. This means adapting to a more digital future, especially with the expected rollout of 5G and greater fiberization across the country. We observe many firms choosing to reach their customers via digital platforms and other touchpoints during the MCO, and it will be a missed opportunity if we were to revert to our old ways. The bank has set aside 300 million ringgit for an automation and digitalization facility to help encourage greater technology adoption in Malaysia by the SMEs. We will also need to earnestly start recalibrating our national investment ecosystem. This will be important to attract higher quality investments that can yield better paying jobs for more people in the future. We have some thoughts on this matter that we publish as a feature article in our economic and monetary review. The article highlighted the need to revamp our existing incentive structure to be in line with the national investment aspirations while ensuring better coordination and alignment between the various agencies responsible for attracting investments to Malaysia. I highly encourage you to give it a read. As we speak, our nation's medical professionals, public health officials, and volunteers are working tirelessly to keep us safe. Bagi pihak seluruh warga dan negara Malaysia, kami ingin merangkamkan setinggi-tinggi penghargaan dan terima kasih kepada semua petugas barisan hadapan yang terlibat dalam menangani COVID-19. Kami turut mendoakan dan mengharapkan yang terbaik. On our part, the bank will remain focused on discharging our mandates through this challenging and unpredictable time. It is my hope that this time next year, we will be able to note that the global community has overcome this health crisis and report on how Malaysia has weathered the economic storm. For now, we will all need to persevere and come together for the sake of our collective future. Remember, Malaysia has done this before, and I do not doubt that we can do it again. Stay safe, everyone.